Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Kevin Davitt, head of index options content at Nasdaq. He joins me to discuss the potential impact that the proliferation of option-based derivative strategies may be having on macro volatility. Kevin, it's great to see you as always. Welcome back to Trade Talks.
So good to see you, Jill. Thank you for having me.
All right, you got it. And certainly there's been a lot of coverage about the potential impact that the proliferation of option-based derivative strategies may be having on macro volatility. We certainly have covered it extensively on the show. How do you and your team think about the topic?
You've done a great job covering this, and there has been much broader coverage as well. Anecdotally, yesterday I was a part of a Goldman Sachs asset management event, and this very point came up. I kind of wonder rhetorically, can a derivatives idea go viral? In my opinion, and I think I speak for the broader team too, volatility levels have returned to normal after years of abnormal volatility. And I think that that applies across asset classes, with the exception of interest rates. And I think interest rate volatility remains high for good reason. Now, I'm not being dismissive of the potential for knock-on effects when you see growth in a derivative or an area of the derivative markets. I think it's a fair consideration. But I also think that on a broader scale, fear sells. I think fear can be a powerful motivator. And I think humans have evolved over a great deal of time, and our base instinct is survival. And some of that plays out in the way this is marketed. So I think when macro market volatility moves to relatively low levels, there's a warranted fear that it might not last. Now, I probably say this too frequently, but change is constant. It's the rate of change that ebbs and flows. So over the past year, and particularly in calendar year 2024, the broad market hasn't moved that much. Realized and implied volatility levels typically move in concert. And if you go a little bit deeper, and one of the write-ups this week on the topic pointed this out, dispersion has been quite high. So you have names in broad-based indices making significant moves higher, some lower. But on an aggregate basis, and that's what indices are, the daily moves have been relatively low. Now, I'll also admit that dealer and liquidity provider hedging can impact price levels on a short-term basis, particularly around big option expiries like we had today. We had the quarterly expiration this morning. But markets broadly work towards equilibrium, buyers and sellers. And I'm not trying to be too philosophical here, but markets seek a stasis. They seek balance day to day, week to week, year to year. The last point, and visually we make this a bit, I've highlighted on the chart the average Nasdaq 100 1-month forward volatility estimates going back 5 years. The average over that whole time horizon is 25.7. Now, the 4-year average skews a little bit higher because of that COVID period that was right around 4 years ago right now. 2- and 3-year averages right around 25.5. But the average over the past 52 weeks is 20.2, way, way below what we have grown accustomed to for the past few years. And that in and of itself can be confusing, but I believe that the option market, just like the equity markets, are seeking equilibrium. And those equilibrium volatility levels have just been higher. We're arguably back to a much more normal volatility level. And I don't attribute that to the growth in option-based products. I think writ large volatility has returned to kind of long-term average levels. And I believe that's independent of the product growth.
Okay, so you gave your opinion on macro volatility and the derivative wrap products. Can you tell us a bit more about what's going on from the product standpoint? What does the audience need to know about this?
Yeah, that is, in my opinion, a really good question because this is an area of significant growth. That topic gets me excited because I believe the growth combines two elements of capital markets that, independent of one another, they have experienced significant growth and they've benefited end users a great deal. So specifically, the ETF market and the options market. You've talked about it for years. I've talked about it. But recent estimates around this option wrapped ETF product highlights that about 120 billion in assets have flowed into these ETF products. Now, that number, just to give it a little context, has doubled over the past year and a half, and it's up sixfold since 2017 when there was kind of the genesis of this growth. So in short, tremendous growth. There are a wide variety of flavors, for lack of a better term, with respect to these products, and I don't want to minimize the broad swath of product, but I also want to be succinct. So in this visual, you can see broadly the number of funds using options are outpacing all the rest in this ETF world. There's buffered product, there's income product, there's all sorts of flavors. And in many situations, these products wrap exposure to a specific index, like the Nasdaq 100, with an options overlay. Some of these products are strictly option-based strategies, and they just trade index options within an ETF wrapper. And that options component could be described as active or passive. The active area has seen most of the growth recently. Now, I could go on and on about this, but for the sake of time, I believe that the options-based ETF growth trajectory is going to continue for pretty much two reasons. Primarily, people want index exposure and they want optionality, but they don't want to necessarily manage the nuance. They don't want to replicate a basket of stocks to replicate the index. They don't want to systematically sell out of the money calls, as one example, and manage rolling that position. So it's very convenient. And across the economy, offerings that save time, save money, and help us meet some goal tend to be successful. And then the second thing is just straight up the ETF wrapper. Now, to be fair, there's a ton of nuance here, but the ETF wrapper is something that many of your listeners, most of your listeners would be very familiar with already. You've highlighted the 25-year anniversary for the QQQ product a great deal lately. People are familiar with ETFs. Now, a second order benefit of the ETF wrapper is that it can deliver returns in a tax efficient way. Now, I am not a tax expert, but when compared to some alternatives, some similar products like mutual funds that make distributions, which are likely taxed as ordinary income, well, the ETF wrapper can optimize that in a couple of ways. And that's something that I would recommend your listeners learn more about, because it can be powerful. And again, I'm not a tax advisor, but compared to some alternatives, there can be meaningful tax advantages. Beyond that, just wrapping this up, the ETF wrapper is making non-linear exposure, which derivatives can provide, available to people without like extra account approvals, without them managing it day to day. It gets outsourced to the ETF sponsor. People are comfortable with the ETF. And I think that there's a real desire for potentially enhanced portfolio yield, downside protection, income, or whatever kind of non-linear exposure options can provide within this familiar wrapper. There's tons of information out there. I did a webinar this week with our partners at Interactive Brokers with one of the options-based ETF providers, if that's of interest. So I think this is an area where we're going to see growth continue, and I believe it's for very good reason. And I'm excited to see what type of product grows in the future.
All right. Appreciate the insight. As always, Kevin, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.